Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. As the Russian invasion continues, market and economic volatility aren't far behind. So here to help me understand what that means for your portfolio is Chartered Financial Analyst and Lineweaver Portfolio Manager, Travis Dragan. So Travis, what's this mean to investors?
Well, U.S. equity markets have been in decline since January of 2022 and fell further into correction territory following this Russian invasion. So the S&P 500 index is down roughly 15% from its early January peak, but the Russell 2000 index and the NASDAQ index both fell into bear market territory, which is defined as a correction of 20% or greater.
Yeah, and while we recognize that the current geopolitical landscape in Eastern Europe remains highly uncertain, we believe history may be a reasonable guide for what to expect for financial markets.
Right, so if we look at historically similar events, such as Iraq's invasion of Kuwait in the early 1990s or North Korea's invasion of South Korea in the 1950s, what we find is financial markets and equity markets tend to peak and begin to decline prior to the actual conflict date as these tensions rise up. And the average decline in the S&P 500 index is in the range of 14 to 21%. So while there may be more downside in the short term, given the magnitude of correction we've already experienced, we may be closer to the end of this correction rather than at the beginning, though we do recognize financial market volatility is likely to remain pretty elevated in the near term.
In our experience, sometimes individual investors tend to make emotional and often irrational decisions during periods of financial market volatility. So your emotions and situations like these can be your greatest enemy when it comes to making the right financial decisions. That's where a professional like Travis can be invaluable.
And Jim, to your point, investor sentiment has declined to extremely pessimistic levels in recent weeks. So this level of negativity is similar to what we experienced during the March 2020 pandemic-driven sell-off, the 2008 Lehman Brothers bankruptcy-driven sell-off, and the March 2009 bottom of equity markets in the global financial crisis. So each of these three previous events frightened investors, but also created some great buying opportunities for investors with long enough time horizons.
Yeah, for example, more and more people moved to bonds as we saw the approaching combined headwinds of rising inflation and interest rates.
Right, and these headwinds are with us today, but they're becoming increasingly more well-known, and therefore appear to be mostly priced into current market prices. However, valuations have significantly improved across financial markets in both the equity and the bond markets.
Well, yeah, and preferred stocks are also showing some opportunities as we see these latest shifts in the market. So basically there are two takeaways. One is don't let your emotions get the best of you, and two, even in times of crisis, there are opportunities for savvy investors. So if you'd like to see how we can benefit your portfolio, or if you'd like a second opinion, please give us a call. We're happy to help.